Applied volatility structure just there. So there it is. And there was posted at 241 just after the cash open. The reason why is because after the cash open, after we've seen the first sort of 10, 15 minutes, the cycles that the market makers are likely to use are becoming clearer for us, aren't they? As a local on the floor of the exchange, I'm now recognizing what the market maker cycle probably is, because we can see it. You know, it's not a guess. It's not something that we can all look at and go, I'm not sure about that cycle. I'm not sure if that's the reality of it. It is the reality of it. We can all see it. You just draw the box, guys. I mean, you might be thinking to yourself, oh, I'm not sure about the logic. I'm not sure about my abilities. I'm not sure if I know this stuff. Of course you know this stuff. It's just what locals have been using for decades. Locals have been using for the beginning of the floor. I mean, it's not difficult, is it? You tell me if those structures were difficult for you to find yourself. They weren't, were they? There was nothing difficult about those structures from a local's point of view. It's just straightforward stuff. Look. So into the cash open, we've got a swing low and a swing high, right? So we're now getting the market maker structure. It becomes visible to us. Well, if that's the swing low and that's the swing high, then all we do as locals all we do now is we draw out where the target prices are, right? We draw out where these target price narratives are located, and we get ready to look for an opportunity to deal, don't we? Is there anything difficult about this? No, right? It's simple, isn't it? So when we look for these things, we simply then start recognizing where the cycles are. Sometimes we don't get to see the cycles until until they've already been positioned. And sometimes we then chase the market. We don't really get in front of the market, but sometimes we still gives us a chance to get in front of the market, like this test back up here. We started to run the liquidities. We started to ask the question about those box trades. And you can see that that in its own right is a micro cycle inside here, which gives us a target price of this. So when we reject that liquidity, or we accept that liquidity as a seller, we reject the break higher, we know that we can go short here in line with the two value lines that are now dropping out of 3. Sell side only, and then of course targeting here, and then targeting here as the implied volatility extends. Then our target price extends with it. And that simply is how easy it was to make that trade. Now we went and made approximately $1,000 per contract on that S&P sell. We came off 5104s, we got down to 50, almost 5084s. If you took the break lower there, you just touched the 84s area, and you were able to make just about $1,000 on the S&P short sell. It's kind of obvious. And yet a lot of people, when you look at this, you think to yourself, I'm not sure how we can recognize those opportunities. Well, you just draw them on the charts. They're not difficult. There's no hidden logic. There's no the logic of the pyramids of anything like that. I mean, it's not something that you're looking at saying, oh, we better tell you a secret. It's not a secret. It's not a riddle. It doesn't have some hidden logic that the banks don't allow me to talk about, which some people like to always put on their ideas. Oh, the banks don't want me to talk about this. And, I'll give you a few clues, none of which lead to anything, but we'll give you a few clues anyway. And, because it's a secret and because it's a riddle, I'll get 1 million followers on YouTube. I'll get 1 million followers, and I'm not even telling them anything. How stupid are some people, honest to God? So it's not a secret. It's not a riddle. It's just the way it is. It's as simple as that, guys. It's just the way it is.